Bitcoin has recently experienced a significant drop, falling below $85,000 for the first time since April, raising concerns among investors. This downturn is driven by a combination of macroeconomic and institutional factors. In this video, we'll explore the three primary reasons behind this sell-off, providing a comprehensive market analysis for crypto investors and finance enthusiasts. The first major factor contributing to Bitcoin's decline is the heightened uncertainty surrounding potential interest rate cuts by the U.S. Federal Reserve. Stronger than expected jobs data has reduced the likelihood of a December rate cut, leading investors to become risk-averse and impacting Bitcoin and other risk assets. The market is now pricing in a lower probability of rate cuts, which directly influences the appeal of cryptocurrencies. The Federal Reserve influences the economy through monetary policy, primarily by adjusting interest rates. Higher interest rates can diminish Bitcoin's appeal. This is because investors may opt for higher-yielding traditional assets, shifting capital away from more volatile cryptocurrencies. The Fed closely monitors economic indicators such as GDP growth, unemployment rates, and inflation to decide whether to adjust interest rates. These macroeconomic factors create a challenging environment for risk assets like Bitcoin as investors seek stability. The second key reason for the downturn is increased institutional selling and concerns over strategies' potential removal from market indices. Digital asset treasuries, or DATs, are selling Bitcoin to conduct share buybacks, as their share prices have plunged below their net asset value. This prompts asset sales to close the gap, contributing significantly to the downward pressure on Bitcoin prices. Some institutional investors are taking profits or reducing their exposure to Bitcoin, further fueling the sell-off. Outflows from spot Bitcoin ETFs, including BlackRock's IBIT, have amplified this downward pressure, totaling $903 million, with IBIT shedding $355 million. Institutional flows, earlier reported as long Bitcoin positions, may actually reflect long-short strategies, further contributing to the decline. Strategy is also adding to market uncertainty as it faces potential removal from the MSCI USA Index and other major equity benchmarks. JP Morgan analysts estimate the company could see $8.8 billion in outflows if it is removed from major stock indices, a significant impact. Broader market dynamics, including the release of delayed U.S. jobs data, have also impacted market sentiment, marking the third key reason. Stronger than expected jobs data reduced hopes of a Federal Reserve rate cut in December, triggering widespread liquidations. These liquidations wiped out billions of dollars across the market, as rapid price drops triggered automatic closing of leveraged positions. Concerns over strategies' removal from digital asset treasuries and MSCI indices further added to this uncertainty, exacerbating the market's vulnerability. Analysts suggest that a key support level to watch for Bitcoin is $74,000, a critical threshold for investors. Some point to a potential mechanical glitch or auto-deleveraging liquidation, known as ADL, flaw that may have accelerated the decline. Others emphasize the importance of global liquidity and the unwinding of DAT trades as significant factors. Bitwise CIO Matt Hogan noted a clash between short-term fear and long-term conviction among investors. He suggests that long-term investors may see this current downturn as a buying opportunity, despite the immediate market sentiment. The market has flipped from greed to fear, with liquidity leaving the asset, highlighting Bitcoin's vulnerability. Bitcoin's trillion-dollar market is built on a thin layer of real capital and a massive tower of leverage, making it susceptible to rapid shifts. In summary, Bitcoin's recent crash is attributed to uncertainty around Federal Reserve policy, institutional selling, and broader market dynamics. While the market is experiencing a downturn, long-term investors may see this as an opportunity for future growth. It's crucial to stay informed and consider these factors when making investment decisions in the volatile cryptocurrency market. Please note, this analysis is for informational purposes only and should not be considered financial advice.